wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deepest seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
It's Friday. It's lunchtime. It must mean it's AQA A-Level Business Live. And well, if Graham's here, we're all set for some AQA A-Level Business revision, about half an hour. And today, Graham, we're doing something which I know is hot on the list of everyone's favourite topics. It's calculations.
Yeah, we love calculations here at Shoot to You, do we not? We do.
Well, we do a few, and we don't make any apologies for that because it's a really important way, particularly if you can work accurately and quickly. It's a great way of scoring big marks to give yourself even more time for the written answers. So welcome if you're joining us live. And we've got 3 chunky calculations to have a go at, but also some MCQs, some new AQA MCQs to have a go at too. But as always, G, should we start with our big reveal whilst our audience are joining us live?
Yeah, George just says, hello, Jim. I'm here as well, George. I'm here. Don't forget me. Okay, should we do the big reveal?
Yeah, Luke's asking, I'm doing OSTAR, would this be of use? Yeah, probably. I mean, there's a lot of crossover with calculations between AQA, EdXL and OCR. Not necessarily every single calc, but pretty much. So I would have thought it'd be okay.
Okay, so under the question mark is the name of a business. Under each number is a clue relating to that business. What is the business under the question mark? So should we have a look at clue number 1?
I think we'll get to clue 3 or 4 today.
Let's hope so. So founded in 2013. So if you know a business that was founded in 2012, then unfortunately it's not the business under the question mark. And if you're thinking of a business that hasn't been founded yet, it is definitely not. But you know, actually, a true story. I was going to be actually called Greg. It was between Greg and Graham. That is
Really?
true. Yeah, it was. That is true. Yeah, that is true. True story. So, question number 2. Clue
Lots of
number two.
people saying Gymshark. That could have been founded in 2013. It's certainly not been around that long. I thought it might have been. Yeah, it could be, couldn't it? Anyway, it's not the right
Yeah.
answer, is it? So
No. So the brand colour and the business colour of this business is teal. So if you're thinking, well, I know now a business founded in 2013, but the business brand colour is orange, then unfortunately, it's not the right business. You have a look at clue number three.
we've made it to clue 3. Awesome.
So it became a public company in 2021, and it raised share capital of £1.5 billion. So we've got Tiffany.
Mhm.
We've got George thinking it's Nissan in Sunderland. That's interesting. We should use Nissan in Sunderland in one of our live streams, shouldn't we?
We never thought of that.
Thomas
have we?
Cooks.
No.
Thomas maybe does cook, but it's not Thomas Cook.
We've made it to clue 4.
We have part of the controversial gig car. We've got there. We're in there, aren't we? We're in there. I think Emily Gervin, I think, was first.
No,
to be
yeah,
fair.
well, you're right. I thought it was Nicole, but actually it's Emily.
It is
Emily was first. Yeah, the AI picks the first person who gets it right. It's all very,
Yeah.
as you know from things like the spinners. It's all AI driven these days. Graham and I just sit here. That's all we do.
Yeah. Yeah, and sometimes when we're pushed for time, we order a live stream from Deliveroo, don't we? And it's delivered 5 minutes before we go on air. So it has a plus subscription service similar to Amazon Prime.
Yeah.
We got someone in the chat window called Jeff Riley. Has never
Never heard of
made
him.
profit and never will. Who's Jeff? Jeff Riley.
Well, let's put him on the screen.
Jeff Riley.
Let's put him on the
Jeff
screen.
Riley.
Just fresh
Riley.
from an economic session, which frankly I don't think had as many people as we've got live for A-Level Business.
Okay.
Right. So so we've mixed this up, haven't we? We've got some MCQs with a calculation flavour, and then we've got 3 dedicated short calculations similar to the kind of calcs that you get in paper 1 after the MCQs.
Okay.
So let's have a look at the first MCQ whilst I give a shout out to Sylvia, who is allowing her A-Level Business class to watch this. Gee, do you want to take this one or shall I do this one?
Yeah, I'll do this one. So a business had capital employed at the start of the year of £700,000. During the year, it added £140,000 to retained profits. And just before the end of the year, it received cash from a new long-term loan of £90,000. All other things being equal or assuming no other changes.
Yeah.
At the end of the year, what is the capital employed? Is it A, B, C, or D? So this tests your understanding of calculating capital employed, which, as we know, could be part of the gearing ratio or the return on capital employed ratio. Straight in with some answers, George. There,
It's quite a hard one, that one.
it is hard. It's whether you understand what is total equity and the overall calculation of capital employed. I think the majority are going for C, aren't they?
Yeah, with a few Ds. Yeah.
Shall we reveal the answer? Yeah, it is C. It is C indeed. Capital employed, we know, is total equity plus non-current liability. So if it already had 700,000, we're just adding the 140,000 plus the 90,000 to that total to get capital employed of £930,000. Good stuff.
Yeah, that capital employed thing, it's about how much finance is invested in the business. So
Yeah.
total equity is share capital plus whatever you keep in terms of your profits. So it added some retained profits. So that was added to capital employed. But don't forget, long-term loans are also part of the finance of the business.
Yeah.
So that's a source of capital. So it's part of capital employed.
And someone's asking, what is the gearing formula? Well, I think you're in for a treat because I think we may be doing that later.
Sophie's speculating that mostly every multiple choice is C. Well, we're about to test that, aren't we? With question 2. Let's have a look. Could be, couldn't it? C is definitely listed there. So this table shows a cash flow or some cash flow information about a business this year. Got cash inflows, outflows, closing cash balance, and sales revenue. And the question is, what was the opening cash balance at the start of the year? So using some or all of the information in the table, can you tell us whether it's A, B, C, or D? Miss Beaton's class also watching. Doubtless we'll get this one right. What do we think?
Some quick working out there. It's a difficult one, that, isn't it? That's a difficult question.
It is. It is.
That's a difficult question.
It's almost like you've got to work in
it
reverse,
out.
haven't you? Work in reverse. Lots of answers coming in. Most people took their time on that, which is good. Often we see answers within like 5 nanoseconds, but that's probably been a minute. And in fact, most people are going for the correct, what I believe to be the correct answer, which is B. So it wasn't C, Sophie, but it could have been. The way we get to this is we're asked for the opening balance. Well, we know what the closing balance was, 81,000. So what happened in the year? Well, we had more inflows and outflows, didn't we? 17,450, is it? Something like that during the year, which must mean our opening balance was lower than the closing balance by that number. So in fact, it is. It's the closing balance less the difference, less the cash inflows, which is 63,550. So very good. Question 3G.
Okay, so it's our good friend, price elasticity of demand, and this business has a product with an estimated PED of minus 0.75. Last year, it sold 25,000 units. If the price increased by 4% this year, what is likely to happen to the quantity demanded? Again, is it A, is it B, is it C, is it D? Certainly one of those. So this tests whether you understand the coefficient and can you apply the percentage increase in price to the coefficient and then take it one step further and look at the fall in quantity demanded. What do we think?
I'm pretty confident that Mrs. Mayweather's students will get this right. They're watching, as are the business boys at Howard Effingham. Lots of classes watching live today. That's why we've up the standard, haven't we, today? These questions aren't easy, these.
Yeah, just remember for AQA, you don't need to know, you don't have to work out the coefficient.
No.
So you'll never be asked that, but you may need to, manipulate the coefficient and apply your understanding of it, but you'll never be asked to calculate it. Not for AQA anyway.
Yeah. In good shape though with the answers.
Yeah. So shall we reveal the answer? So quite straightforward question, really. When you break it down, that coefficient tells us that for every 1% change in price, the quantity demanded will change by 0.75%. So we're increasing the price, so the quantity demanded will fall. To find out the percentage change, we simply multiply the 4% by 0.75. So that'll tell us that the quantity demanded will fall by 3%. 3% of 25,000 is 750 units. So there was a few stages in that, and it all comes down to whether you recognize that 0.75 means that for every 1% change in price, the quantity demanded will change by 0.75%. That's what that coefficient means.
Yeah. Okay, we've got now we talked about the gearing percentage earlier. Somebody was asking about it. Well, here's a chance to apply it. So we've got a table of information there drawn from the statement of financial position at the end of December 23. Information about current assets, non-current liabilities, total equity, and current liabilities. And the question is, what was the gearing ratio of the business at the end of December? What do we think? Abs is asking about Abdul to see if its price inelastic quantity would increase, but not if we increase the price. So normally with PED, if we increase the price, we'd expect quantity demanded to fall.
Definitely.
What do we think the answer is here? Good to see lots of quick answers, accurate answers coming into the live chat. Should we have a look at the answer, G? I think we should.
Definitely.
It's D, isn't it? Yeah. So relatively straightforward, this one. You could ignore current assets, ignore current liabilities. Those would be really useful if we were looking at liquidity ratios, such as the current ratio, but we don't need that for gearing. The gearing ratio is non-current liabilities, £15,000, divided by capital employed. And don't forget, capital employed is non-current liabilities or debt plus total equity, how much the shareholders have employed in the business. So that's 110,000. So it's 15 over 110 is indeed 13.6%. And our last one, G.
Okay, so we've got a business here with an inventory turnover of 12 times. The business achieved a gross profit margin of 75% and the sales was 1.5 million. what was the average inventory held in the business this year? So quite a challenging question. So you need to work out, firstly, you need to know what the formula really is for inventory turnover. And from that, you can work backwards to calculate it.
So I'm thinking inventory turnover, which is often examined, isn't it? Partly because it's often poorly answered.
Yeah.
I'm thinking the formula is cost of sales
Divided
by average inventory.
That's so yeah. So you would need
And
to
we
work
know
out.
the answer is 12. So the missing number is, we need to work out cost of sales, don't we?
Yeah. So you need to work out cost of sales. And I think a lot of students are working out the cost of sales.
Yep.
And putting that down as the answer, which is not strictly correct.
Yep.
So there's another step in the calculation. So a lot of students are working out that obviously cost of sales must be 25% of 1.5 million if the gross profit margin is 75%. So I think we've seen. I think I've seen the first. There's a couple of correct answers. Yes, it's tricky. I think
Luke, Ella, amongst others. Yeah.
Okay, should we reveal the answer?
Yeah.
So it was 31,250. So how we work that out is we know the cost of sales must be 25% because the gross profit margin is 75%. So if we work 25% of 1.5 million, that gives us the 375,000. And we reverse the formula, dividing that by 12, which was the inventory turnover, will give us 31,250. And you can work that backwards. So dividing 375,000 by 31,250 will give us 12 times.
Snack Bandit is provided us the working and, more importantly, made a claim that Snackers, a regular contributor, was first. We'll get the AI to check that, I think, G, won't we? But it's great to have a useful formula put into the live chat.
Okay, so Jed's saying, what's the formula for inventory turnover? It's cost of sales divided by average inventories held. It was examined by AQA a couple of years ago. A lot of students struggled with it, and the students who did work it out didn't put the word times after. So
yeah, Nicole's asking, why would it be 25% for cost of sales? Well, because the gross profit margin is 75%, so the difference must be the cost of sales. So the 75% tells us that for every £100 of sales, we make a gross profit of 75%, which must mean that we make cost of sales, or the cost of sales must be 25%, isn't it? It's the difference between 100%, which is sales, and gross profit 75. So cost of sales must be 25%.
Yeah, there's a question there about when we're talking about the actual inventory turnover, it's how many times does a business sell its inventory over the year? That's why it's expressed as times rather than units. It's not how many units the business sells. It's how many times over the period it sells its stock. Hence, inventory turnover is expressed as times. You can express it as days, but that would be an extra calculation after that. So I would just stick with times.
Now, we've got 3 sort of paper 1 style calcs, haven't we, G? We typically we're 3 or 4 marks each. Obviously, we've not applied a specific number of marks to them, but maybe 5 minutes on each to take our time on them and see how we get on. We often get answers coming in before we set the 1 minute lift music. So here's our first one. So again, I'll set this one off, G. Maybe you can help us through the answer. So this one's on operating profit margin. Now we're going to have to do a little bit of data manipulation here because we've only been given those 3 pieces of information. We've been given the gross profit margin, gross profit divided by revenue. We've been told what that answer is, gross profit. And we're also told what the expenses of the business are. And so from that, we should be able to calculate operating profit and express that as a percentage of sales revenue. There's a bit of work to do. Don't forget it's a margin, so we're looking for a percentage. Shall I start the clock, G, before the answers come in?
Yes, please.
Okay. Number of people pointing out that they've got the badge. I've also got a badge. Have you got yours on, G, today?
I haven't actually. No, is the answer to that. No, I've got a bag full of them, though. Lots of answers coming through.
Didn't think it would take long.
Remember, operating profit margin is a percentage.
Looking good.
Yeah, great work. Well, the badges, Summer Lever, they were exclusive, weren't they, for the workshops that we did in the cinema, where students who participated were rewarded. Potentially,
We are looking at making them available, though, aren't we?
Yeah, we might put them on the website.
We've got our best team working on that.
Yeah.
Well, it's great to see so many accurate answers. I don't think I've seen an incorrect answer unless you spotted one, G. One or two missing the percentage sign.
Yeah.
Jed's
one or two
gone
missing the
through,
percentage time, which is important.
I'll stick Jed on because that was one of the several people in the live chat who showed the workings there.
Yeah.
Shall I show the workings, G, and you can take us through it?
Yeah. Let's go through it. So we know the formula: operating profit divided by sales revenue times 100. Even if you couldn't work it out, I would have wrote the formula down. You get a mark possibly for that. So sales revenue is gross profit divided by gross profit margin times 100, which gives us a £400,000. Operating profit is gross profit less expenses to give us a 76,000. So the 76,000 divided by the 400,000 times 100 is 19%. So for every £1 of sales revenue, the business makes 19p of operating profit. So I think the thing there was working out really what the sales revenue was. That was possibly slightly trickier. So if the gross profit margin was 65% and gross profit was 260,000, 260,000 divided by 65 times 100 would give us the £400,000.
Yeah, someone's asking why we're not finding 35% of 400,000 because that would be cost of sales, wouldn't it? So if you added 35,000 of 400,000 to the gross profit, that would give you sales revenue. So that's the missing number.
Perfect. And if you work out 65% of 400,000, you'll get the gross profit.
Yeah. Now, typically with AQA, you'll get the gross profit number. Expenses, it's a bit like overheads, isn't it? Other costs. So that's the number that you take away to get to operating profit. So gross profit less expenses. The expenses are 184. They're not cost of sales. They are other costs, non-cost of sales.
Yeah, so someone's asking why do you deduct the 184,000? Because we know to get operating profit, it's gross profit minus our expenses. We're given the gross profit 260,000. We knock off the expenses of 184,000, and therefore that gives us our operating profit, which is the top part of the top part of the formula.
Okay, that's our first one done. Now it gets a little bit harder now because we're moving on to Graham's favourite topic, and probably, to be fair, mine as well, investment appraisal. But we're having a go at net present value or discounted cash flow today. We've not done much of that, have we, in recent sessions?
Yeah.
We've tended to focus on payback and ARR, but here we've got some information in the table. We've got the net cash flows or the forecast net cash flows for a investment project, 1.2 million going out at time zero, and then 3 years worth of net cash inflows. So we're given the net returns, aren't we? The net cash flows.
Yeah.
We're given the discount factors, and over to you to do one or both of NPV and ARR. And because they're not easy, natural round numbers, maybe round the ARR to 2 decimal places.
Yeah, that might be handy.
Shall we start the clock, G?
Yeah, let's start the clock. So if you can do both in a time, that's great. If you just maybe want to choose one, that's equal as good. We're going to go through both anyway. So,
wow. It never ceases to amaze me how quick people are. Dominic, Rachel, wow. We've got some great workings being put into the live chat as well, which is phenomenal.
Yeah, lots of great answers coming through. It seems as though a lot of us are focused on ARR, which is fine. But we have got our first, we've got a couple of Joe there. Kima.
Yeah, Joe and Vu has even put the workings on. So, we'll check that answer shortly, but that does look like it could be right, although it's a negative MPV. Interesting, isn't it? Minus 115, and Joe's double-checked those workings, also going for minus 115, 115,500. And our QG. Quite a few people going for the same number. This must mean it's the same thing. I've picked out a few that Ella reckons ARRG is 4.17.
Mm-hmm.
Dominic agrees. Loads of answers coming in. It's terrific. And JJ has actually put the workings on to get to the same number, 4.17. An amazing piece of work there on workings. What do you think? Is it time to look at the answers, G?
Yeah, if you put 4.16, that would be okay. Remember, we just rounded to 2 decimal places. So normally in an exam you wouldn't. It would be very, very clear cut. But well done, great work, everyone. Should we have a look at the answers?
Why not?
So an NPV. So remember, you multiply the net cash flow by the discount factor, and that's the only method of investment appraisal you do that. So it was pleasing to see that no one applied the discount factor when calculating average rate of return, which does happen rarely, but it does happen. So you can see every year we've multiplied the net cash flow by the discount factor, and it's the further we go into time, the more heavily it is discounted. That's the whole concept of NPV. So we add our discounted cash flows together, deduct the cost of the investment, and in this case, we have a minus figure of 115,500, which I think every single person who worked out NPV got, which is great. Remember, you've got to deduct the cost of the investment for NPV. And for average rate return, all we're doing there is we're adding up the net cash flows, deducting the cost of the investment, then dividing by the number of years, divide by the cost of the investment again, and times 100. And my tip would always be, when working out average rate return, if you're given the net cash flows, start off with the cost of the investment as a negative amount in your calculator, then add on the net cash flows, then you've automatically deducted it. Yeah, it's easy to forget.
Easily done.
Year zero, easy done. So in this case, we've rounded it to 4.17%.
That's that net present value of minus 115,500, 115,500. It's negative.
Pretty decisive. You wouldn't go ahead.
Don't forget, you don't often see those, but you could get one in an exam. You might be given the results of a net present value calculation. That would suggest they should not go ahead with the investment. So the basic rule is, if the NPV is positive, you should proceed with the investment. If it's negative, you shouldn't. That's the basic rule of NPV, discounted cash flow. Of course, you might question whether the forecasts are accurate or not, but it's quite interesting.
Great stuff.
Good stuff. We're in good shape, aren't we? I think we've got time for our last one.
Yeah, let's branch out. Let's branch out into
I see what
decision
you did there.
trees. Yeah, see what I did there. Turn over a new leaf. We've got.
Just before we do that, though, Alice is saying, "Hello, Jim. I love watching your lives. Thanks a lot for helping us do this." Alice, it's not just me, is it? It's me and Greg. So
I'm just thinking maybe there's very little point in me actually being here these days. Just I won't bother. I won't bother for the next one.
Don't say that, G. Don't say that. Talking of branching out, take us through this one, mate.
Would you believe it? So we have a decision tree here. We have a decision tree. So we've got a number of options related to Ansoff. So a business is looking at a market penetration option, whatever that may be. It's looking at a new product development option, whatever that may be. And we have the estimated, returns and probabilities of success and failure associated with those options. Remember, there is always an option to do nothing. And I find that it's increasingly my go-to option in life, the do nothing option. So can we calculate the net gain of option A and option B? Read the numbers very carefully before you proceed. Make sure you read the numbers carefully. So have a go calculating the net gain for market penetration, which is option A. Then have a go at calculating the net gain for new product development with option B is, and remember, you need to work out the expected value, then knock off the cost of the investment to get the net gain.
We better get the clock started because Charlotte, amongst others, is already in the live chat with some sensational work. So let's start the clock.
Okay.
I think Gabrielle is the first person in with both in less than a minute, more like 45 seconds. It's just phenomenal work. It would take me half an hour. And I wonder why I don't finish papers.
Yeah, lots of correct answers in the chat window. Recognizing, aren't we? We're recognizing everyone, recognizing that it is a failure results in a negative amount, which has been examined previously,
It has,
and
yeah.
some students didn't pick up on this.
It's an
So,
obvious thing to include an AQA question, isn't it? Because by including a negative amount, which is a loss, isn't it? So a failure, a loss. It's an obvious way of students who are reading the questions carefully discriminating themselves or differentiating themselves. They call them discriminators, don't they? From students who maybe don't quite read all the information as it's presented.
what's interesting is if we look at this, decision tree before we look at the answers, market penetration strategy, which Ansoff would argue carries the less risk. So we can see that transpires to have a higher probability of success where new product development, which is more risky, according to Ansoff. Therefore, the probability of success is lower, but a higher return potentially. So what we're seeing is really market penetration. Are we seeing, Jim, low risk, potentially low rewards, higher risk, potential higher rewards?
Could be, couldn't it?
It's an interesting thing to tease out. Shall we have a look at the answers?
We will. But just before we do that, William's asking a good question. I mean, we've deliberately written this one to show negative numbers, and generally, those might be associated with launching something. So you could make a loss, couldn't you? So it might, for example, we could have put launch new products or enter new markets, because that gives you an opportunity to show a negative number, a loss. I've seen decision trees with AQA where all the numbers, including failure, are positive. For example, it could be high sales, low sales.
Definitely.
So it could be presented in numbers of different ways. But I think the main thing is just to look at those options and see what the outcomes are, and just double check to see whether there's any negative numbers in there.
Yeah, if it's in brackets, that's something that's like a flag there. You need to be aware of that. Sometimes they're shown as a negative amount. Sometimes they're not. It's just being able to recognize that, which was the and we got that, didn't we? So I think the majority of students got the fact that the net gain for market penetration was 120,000, and the net gain for new product development was 50,000.
Yeah,
So
Gabrielle, according to the AI, of course, all these sessions are now driven by AI, nothing to do with us, purely random in terms of what we say. But I think Gabrielle was the first with both answers in about 55 seconds.
Yeah, so remember, you're multiplying the probability by the expected return for success and failure, adding those two together to get our expected value. Then we deduct the cost of the investment. Now, remember, in this case, the expected value of failure was a negative amount. So we would deduct that rather than adding it on. So,
good question coming in from Joe about this, about decision trees. Is doing nothing an option? Well, yeah, it is, isn't it? I mean, there's always an option, particularly if the net gain proved to be a negative number for one or certainly both of the options. Then you'd probably say, well, let's not do it, or let's revisit the project. So at the end of the day, I think the important thing about decision trees is they're based, a bit like investment appraisal, based around forecasts. You're forecasting probability. So that last one is a coin toss, isn't it? Option B, 50% either way. You might revisit the investment cost. You might revisit the probabilities. So that's often why decision trees aren't really used much in business, whereas investment appraisal is, because it's hard to work out the probabilities. But yeah, Joe, doing nothing, you do nothing if they both said negative, I would say.
Yeah. Great work, everyone. Really, really impressive. Really impressive. And what was really impressive, Jim, was how many students got the answers before the before the clock.
You're getting some love now in the live chat, Greg.
Isn't it? And speaking of clocks, and time. Do you know what I did yesterday, Jim?
No, what did you do?
I spent all day yesterday making a belt out of broken watches. Complete waste of time. And on that note, it's about time we had a watch joke.
So Moyes was asking a question. Let me go back to it. He's been very patient, asking a couple of times, which links in really not just to the calculations, but also to when we were looking at 9 markers. And of course, it'd be particularly relevant when we're looking at 9 and 16 and 6 markers for paper 2. can you get the application marks without mentioning real world businesses? It's worth just a minute on application, G.
Yeah, you don't have to be. I mean, of course, it depends on the question, but you're not expected really to bring in, real world businesses. In paper two, which is where, paper two is the data response paper where you're given 3 case studies and questions relating to that. So you need really to relate your answer to the businesses in the case study. Of course, on paper two, which we'll do a live stream on, you do have what we call the open questions, where you're expected to go beyond the business in the case study and use different industries, markets, and segments. So you don't need to use business names as such, but we'll cover that. We will do a live stream on paper two, and same in the 25 markers. The 25 markers, yes, you need to show application, but that doesn't necessarily mean you have to use the name of a real business. You could use an industry, a segment, a market. You don't have to use the names of real businesses. There you go.
Well done, Mr. Allen, for letting Alice and the rest of the crew watch this live. It sounds like fish and chips on the menu. I must admit, I'm a bit peckish, G, but normally I pop over to Coupland's or Greg's after our live sessions.
Well, it's a Friday, isn't it? So maybe you should have a little bit of fish, Jim.
Could be. Could be. I might just go from a normal sausage roll. So we are up and running with our live streams. We've got another AQA session, I think Sunday, doing a bit of 25 markers. I think that's me. Monday, I think we're doing a warm-up, aren't we? Paper one warm-up, a bit of a Q&A clinic before paper one. And then once we've got paper one out the way, we've got a week to help prepare for the sort of the case study paper two. So we'll do some more live streams. And you can find them by subscribing to the Tutor YouTube channel, and you'll get a notification when the new sessions are added. Don't forget, there's also a playlist of all the AQA sessions. So you can see them as soon as they're added. You'll see them on there, and you'll see them. If you just click on the bell icon, you'll get a notification when we're going live. I think we're good to finish. Any final comments, G, before we say goodbye?
Just well done, everyone. It's really, really inspiring to see how many people take the time out of the day to join us, and and have a go. And that's what it's all about. Whether you get the answers right or wrong, it's all about having a go. And hopefully, you've picked up 1 or 2 things that you found useful. If you have, please give us a thumbs up, subscribe to the channel, and and have a great weekend.
Indeed. Awesome. Have a great Friday. Keep revising, but don't spend all the time doing it over the weekend. Don't forget to spend some time on you, bit of relaxation, and we'll maybe see you Sunday, but certainly on Monday ahead of paper one. So cheers, G, as always. Have a good weekend, everyone.